In the 13.2 subsection on money and banks, we're going to be talking about how banks actually create money. Now, first of all, this sounds like a pretty strange concept because most of us are used to thinking of money being created by the federal government, but it turns out that banks themselves create money. It's a really interesting behind-the-scenes process where they don't print money, they create money. I'll show you the difference when we get into a couple more slides, but I just want to put this idea in the back of your head that not only does the federal government create money when they print it, but banks also create money. How do they do that? Well, they do it by using the transactions and savings accounts that we talked about earlier. Transactions accounts meaning checking accounts. So, deposit creation. This is the creation of transactions deposited by bank lending. So, these bank accounts are not physical lumps of cash. Excuse me. They're computer data entries. Presumably everyone recognizes nowadays that an awful lot of stuff is simply created by someone hitting the keyboard on a computer. And so a few keystrokes by a bank can either increase the money supply or decrease the money supply. Let's explain how this works. So banks create money by making loans. So whenever a bank lends somebody money, it credits that individual's bank account. So obviously the creation of a loan puts money in someone's bank account. So in making a loan, the bank effectively creates money. Now, how much money that can be created through this process will be regulated by the Federal Reserve System. So ultimately, we claim the Federal Reserve controls the basic money supply. Let's get into a little more detail on how the banks do this. The first thing we need to recognize is that whenever you deposit cash or coins in a bank, and we're just going to refer to coins as cash, you are only changing the composition of the money supply, not its size. Because we're assuming that if you deposit cash, money was taken out of some other bank account. So you increase one bank account, but you decrease another. We're going to have to find a situation where you have net new money being added to the system. But for now, the vast majority of transactions, like when you get paid and you put the money in your checking account, you don't actually change the money supply. Because when your boss, let's assume you use direct deposit, your boss deposits it in your account, so your account goes up by $2,000. What happens to the boss's checking account? It goes down by $2,000. So what's true about the total money supply in the bank? It remains the same, doesn't it? It just changes whose account it happens to be in. So that would not give banks the ability to make extra loans. So we're going to skip the rest of this slide. Your author has included it, but it's adding complication to an issue that really will deflect us from understanding. So let's continue on, and then at some future point we'll make use of this information. So now we have to take a look at something called fractional reserve banking. Fractional reserve banking refers to the fact that bank reserves, which are the cash that people put in the bank, all of it is not held by the bank in the vault. Now, many of us probably think that I take $100, take it to the bank, put it in the bank. My $100 is literally in my account, like in a post office box with your name on it or something. That's not true. The bank simply takes all of the deposits and aggregates them all together and then lends most of that money out. So you put money in the bank, let's say a literal $100 bill that you wrote your name on it, so you could keep track of it physically. When you put that money in the bank, that money will almost within a day or two be lent out by the bank. Now, when you get your bank statement or go online and look at your bank statement, what does the bank say is in your account? It says the $100 is there, and you believe them, right? But the reality, of course, is that $100 is not in your checking account. That money is lent out. That's what banks do. They'd all go bankrupt if they didn't lend the money out because they would earn no interest. So banks lend it out. Now, they can't lend all of it out. They have to keep some of it in reserve by law, and that's called the required reserve. And the Federal Reserve sets that number. So this is the minimum amount of reserves a bank is required to hold in cash in the vault. The rest they can lend out. So the reserves are the amount not lent out. And the required reserve ratio will be a numerical, percentage number that tells the bank how much they must keep of their total reserves, how much must be kept as required reserves as cash in the bank. So it's a relatively easy formula, which we have right here in front of us. The required reserves that a bank must keep in cash is the required reserve ratio, which the Federal Reserve tells them that what that is, multiplied by total deposits. Let's do an easy one in our head. Let's assume that the Federal Reserve has required that banks keep 10% in reserve. So the total deposits, I'm making up a number. Let's assume that people have deposited $10,000 in cash in the banks. How much must the bank keep in cash? Well, 10%, times 10,000 is 1,000. So the banks must keep in their vault $1,000 worth of cash, and then the other 9,000 of the 10,000 originally deposited, they can lend out to other people. And that's going to be crucial for understanding how banks create money supply. So at this point, it's relatively simple. We're at the stage of thinking, yes, banks collect cash, they keep a small amount on reserve in cash in the teller drawers and in the vaults, and then the rest of it they lend out because that's their business. They're in the business of lending. Now, since the banks must set aside some of its deposits to satisfy the reserve requirements set by the government, it makes loans only of the remainder. Now, it can make loans out of what are called excess reserves. Now, banks oftentimes keep reserves in excess of required reserves. So, excess reserves, let's look at our formula now in our little box. The excess reserves will be the total reserves, meaning how much cash does the bank actually have in the vault, minus the amount that they're legally required to keep in the vault. So, a minimum reserve requirement directly limits deposit creation because obviously if you keep excess reserves, you're not making as many loans as you could, and we've already said earlier that making loans creates money supply. Now, I haven't demonstrated that yet. At this point, I'm simply asking you to take my word for it. In another slide or two, we'll demonstrate why this is true. So, as we pointed out, excess reserves are the maximum amount that any bank can lend because the excess reserves are the amount of cash they're keeping that they're not legally required to keep in the vault. So they are allowed to lend out the excess reserves. So let's take a look in a multi-bank world. As we know, we have multi-banks, right? Rather a multi-bank world. There's Chase, there's Truist, there's, I can't think of all the Renaissance Bank, I think I've seen their name, South Bank, I can't name them all because I can't think of the brand names off the top of my head, but we realize that there's lots of banks in the United States. So in a world in which there are multiple banks, let's go through an example through stages of how a deposit can create new money supply in a bank. First of all, we're going to assume a depositor puts cash in the bank. This cash has never been in the bank, it's just sitting, let's say, under someone's mattress. They finally decide to, oh, we need to keep this safer, let's put it in the bank. Let's assume it's $10,000, just so we have a nice, easy, round number. So we put $10,000 in the bank. The bank now has excess reserves. It has $10,000, but how much is it legally required to keep? Let's assume 10% to make the math easy. Of the 10,000, they're required to keep 1,000. So how much of that, of the 10,000 that deposited is now excess reserves? It'll be the 9,000 remaining. Total reserves minus required, so total reserves of 10,000 minus the 1,000 they're required to keep, 9,000 is excess reserves. Now, banks are in the business of making loans, so they're going to take that 9,000 and they're going to make a loan from those excess reserves. This will create money supply. Now, the borrower who borrowed that money, they spend it, and whoever they spend it with, the seller gets that $9,000. Let's, again, to make it easy to understand, let's assume you're going to a used car dealer to buy a $10,000 car. So you borrowed a $9,000 car. So Uncle Joe took money out from under his mattress, 10,000, put it in the bank. The bank can lend out 9,000 of it because that's how much is excess reserves after they set aside 1,000 as required reserves. The 9,000 you borrow to go down to the local car dealer to buy a $9,000 car. What does the car dealer do with the 9,000? They probably won't put it under their mattress. Most likely they'll put it in their bank. So Uncle Joe believes he has $10,000 sitting in his bank because that's what his bank statement says. But the bank has lent the money to you. You spent the money. It now ends up in your car dealer's bank account. So Uncle Joe has $10,000 in his account. The car dealer now has $9,000 from your buying the car in their account, in their checking account. Well, what's the definition of M1? Add up all the checking accounts, among other things as well, right? But add up all the checking accounts. Well, Uncle Joe's $10,000 checking account and the car dealer's $9,000 checking account. Do you realize you have $19,000 in checking accounts or money supply? But originally, how much actual cash was there? Only $10,000 printed money. Oh, isn't that cool? The bank, through the process of making a loan, gets converted into somebody else's deposit, and they believe that money's sitting in the bank. What do you think that bank, now the car dealer's bank, collects $9,000? Can they lend out the whole $9,000? No, they can't, because they're required to keep 10% in reserve. So out of $9,000, they have to keep what, $900? That means they can lend out $8,100. Let's assume they lend it to someone who wants to go on vacation on a cruise ship that costs $8,100. So the money now ends up in the cruise ship's checking account. So now let's add it up. We have $10,000 in Uncle Joe's account because he deposited money from under his mattress in the bank. Then the car dealer ended up with $9,000 in their checking account, and then the bank lent that money out, and the person deposited that loan at Norwegian Cruise Line's account. So Norwegian Cruise Line believes they have what? $8,100. The car dealer believes they have $9,000. Uncle Joe believes he has $10,000. You start adding those all together, you realize, oh my goodness, the banks are creating more money than ever existed in cash to begin with. But that's what I was trying to prove to you. But you notice, since you take 10% out as required reserves every time, does this cycle go on forever? No. It repeats itself, but in smaller and smaller amounts. As you pull out 10,000 that must be kept in reserve in the bank, the rest gets lent out. So a smaller and smaller amount gets lent out with each cycle until eventually it peters out into nothing. You add all those dollar amounts together and you realize the banks have created a humongous amount of the money supply when there was only $10,000 printed to begin with. In this slide, we are going to take a look at how much can be created. This is referred to as the money multiplier formula. The money multiplier formula, as you can see in orange right in the center of our screen, is 1 divided by the required reserve ratio, whatever that number happens to be. So let's look at the next box in the lower left-hand corner. Again, I'm going to assume 10% so we can just do the math in our heads. I don't want to make this complicated. It doesn't have to be 10%, but in fact, the Federal Reserve often uses 10% to make it easy. So how do we calculate the money multiplier? We'll plug it into the formula. 1 over the reserve ratio. If the reserve ratio is 10%, when you do math with a 10% number, it turns into what? 0.10, right? You got to decimalize it. So 10% is 0.10. 1 divided by 0.10 is 10. So what does the number 10 tell us? The number 10 says if Uncle Joe takes money from under his mattress that has never been in the bank, it's now put into the bank. Of that amount, how much will the money supply grow once the banks start going through that lending process? You take the money multiplier times the amount of the original amount of money deposited, and that will give you the total amount of money created. So the $10,000 originally deposited by Uncle Joe times 10 gives us $100,000. So 10,000 of it was printed by the government, and Uncle Joe kept it under his mattress, deposits it in the bank. The banks, through this lending process, eventually end up creating an additional $90,000 for a total of $100,000 worth of money in the banking system. Now, of course, there's only 10,000 of actual printed money. All the rest are merely deposits in the bank that you simply believe exist because your bank says, well, here, look at your bank statement. I got it printed out for you right here. It shows you have, the car dealer has 9,000 in his account. The Norwegian Cruise Lines has 8,100 in their account. And we all just simply take the bank's word for it. But if you actually went to see if you could find the printed cash, it's not there. Remember, there was only originally $10,000 printed. The banks create, through the lending process, they invent this money through the lending process. It's almost hard to describe. It's like magic, isn't it? But it really is true because everyone believes that their particular checking account actually has real money in it. And it does. If you went and wrote a check on that money, the bank would honor the check. So it really is money, even though only 10,000 was originally printed. Now, this will end up becoming very important to recognize. The Federal Reserve will ultimately control the total amount of money supply by controlling the reserve ratio. They can determine how much banks can lend out, And therefore, by setting a higher reserve requirement, let's say 20%, then 1 divided by 0.20 is only 5, then the banks can only increase the total money supplied 5 times from the original printed amount. But if the reserve ratio is only 5%, 1 divided by 0.05 is 20, they could create 20 times the amount that was originally printed. So the Federal Reserve knows this is going on, so they set the reserve requirement where they want it to be in order to know how much total money supply will ultimately be printed. So later on down the road, when we start using the total money supply in our calculations, this will be an important point.